15th edition of this crystal ball outlook of the energy markets for 2025. For the 12 months ahead, what does it look like? We have over 70 analysts joining us over the next 12 hours from 20 time zones, would you believe? Over 26 sessions where we will be taking the pulse from the ground in all of the relevant places as to where things may go. The year kicks off with Brent crude oil trading at around $76 a barrel. A handsome enough number if you are a producer. Generally, consumers don't shout too loudly in pain at these levels. So maybe it's the Goldilocks spot, mid-70s, everybody's happy. But we kick off as one should in a global energy outlook in China this morning with Dr. Wang Zhen, president of the Chinese National Oil Offshore Company Energy Economics Institute. And we are very glad to have him with us. No better voice, the anchor of the global oil markets really has been the incremental China demand growth over the last 30 years or so. Welcome, Dr. Wang.
Hello, so it's my pleasure to be online.
Thank you, Dr. Wang. Dr. Wang, let's start out with the sort of standard Chinese question. Every year, the Chinese government identifies a growth target for the year ahead. Again, like last year, the Chinese government has identified that the Chinese economy will grow this year by 5%. What is your expectation for reaching that target? It would appear last year was very difficult to achieve it. This year, the Chinese New Year begins, the World New Year begins. How is your thoughts on China achieving this year's 5% target?
Yeah, so 2024, we know so the Chinese government targeted the 5% GDP growth rate. So until now, so even the government didn't release this number. So from the most of the institutions and the news and believes so the 5% GDP growth rate would be arrived in 2024. And of the 2025, so most and more news released, there's a GDP growth forecast. So I believe so the 5% also may be the target for this year. So as you know, 5% of GDP growth rate is very important for China's development, especially for the employment. And
but is it achievable? Is it achievable?
Yeah.
Is it real? The world needs to know that China data is real. Is 5% realistic? We've started the year, the Chinese stock market has been collapsing. There's the bonds, the outlook for the 10-year bond is at a near record lows. Deflation has become a very big problem for the Chinese outlook. Is it realistic to target 5%?
So, so as you know, so I just predict the 5% is necessary for the development as well as for employment. So of course, so it's we face the external server challenges and also domestic hard difficulties. So it's very hard to realize this target. But anyway, so we know the next year, so as the 2025 or 2024, so we also know it's very hard. But now, so I believe it's almost can realize this target. And for the 2025, I believe the 25% is also very hard. But I believe so China as internal a big market as well as reform policies are released, and more and more local governments and the central governments release their policies, especially to let the market dominate the policy can be much more and more important, play more and more important role. So
how important, I mean, the realistic outcome, how important, what role will stimulus play? We saw in the last part of 2024, the Chinese government finally started to unleash some stimulus measures. So far, they haven't really worked. What is your expectation that the Chinese government will continue to install a stimulus into the Chinese economy? And what could that look like? What does it need to look like for it to be effective?
Yes, I agree with you. So the Chinese government, without that, will take much more stimulus policy. So, and in the 2025 will be somewhat different from last year. So government will take much more active policy. So maybe we can also much more active the fiscal policy, as well as change the monetary policy from the modest to the somewhat active the monetary policy, and also some of the industrial policy. I believe so the much more active policy will let the market participants can relatively easy to access to the capital, and that sometimes stimulus the consumers to consume much more in this year.
But the Chinese consumers, they want to save money. They want to put money in the bank. They do not want to spend money. How can you make the Chinese people spend money, buy things?
Yeah, so traditionally, so of course, so the Chinese countries is save money and save money to the bank. So, but we know so more and more young generations, we know so they have the different attitudes towards the consumption. So, and also the government, the central government and the local government adopt the active consumption policy. So it's as the last year, especially we also since the December, July, June, and we also November. So more and more active consumption policy released, and especially so the government pushed all the encourage the consumers as well as the companies to buy new products or the new subsidy to as well. So the government takes some of the active or the encouraging policy. So I believe so we also this kind of policy has still played some roles, and I believe in the 2025. So and the more active that or encouraging policy, especially for the consumption policy, will be released.
You expect more. You think the Chinese government will give more stimulus? Yes.
Yes, sure.
Yes. What about the final question for you, Dr. Wang, before we bring up our second interview this morning? That is, Donald Trump is coming back to the US presidency. He has also already made it very clear that he's going to put more tariffs on China. What impact will that have on China, and how will China react?
So we also the United States, the elected President Donald Trump had released some of the policies, especially on the add the import the tax. So without that, so this kind of policy will have the not the good effect on the international trade. So, and China, of course, is one of the biggest trade partnership of the United States. And this kind of policy will harm to the bilateral relationship, especially so the economic and the trade. So for China, of course, so we know that China's very big market, very big internal market. And just this week, so the NDRC of the Chinese government released the policy on how to develop the internal or domestic market. So the most important thing is so how to let the different processes can easy or
what
easy
will
to
China
attach to.
do? How will China react to this tariffs? Will they retaliate?
Sure.
What will retaliation look like?
Yeah, so I believe so is once it expand the domestic consumption, and at the same time, so we also expect the trade with the world. Of course, so if the United States takes much more policies on the import the tax, so maybe can expect more and more to the developing countries, with especially to the Europe and the Belt and Road areas countries.
So the Chinese will look for other markets.
Yeah, sure.
Will they retaliate to the US? Will they ban the export of rare earth minerals? Will they ban the export of oil products? What are your thoughts on that?
So the China is one as the biggest of the oil products import. So the
Exporter.
China would like to import more from the United States as well as the world. So, but we also depend on the market, depend on the advantages of the different products. So I believe this kind of policy will have some implications of the effect to the international oil market.
Right. Let's finish our session with the survey question here before we go to the second interviewee. How do you expect China's economic growth in 2025 to influence global oil markets? Will it, one, increase oil prices due to higher demand from China, stabilize oil prices with moderate demand growth from China, or decrease oil price if demand weakens from China? How do you expect China's economic growth in 2025 to influence global oil markets? 1, bullish; 2, little impact; 3, bearish. Which of these 3 do you think that China will impact oil prices? Your last comment, Dr. Wang, how do you think China will impact oil prices in 2025? Will it be bullish, as it has been for 30 years, or will it be bearish?
So I believe in this year, 2025, so the oil price will lower than the last year. So just because of the world economy is not so strong, and also the supply side, I believe we are much more supply from the non-OPEC plus countries, and especially for the China. So we also the oil products, all the refined products almost amount to the peak. So that means more and more EV and LNG will replace some of the consumption of the gasoline and the diesel. So that means the oil price would be low than that of last year, maybe the $5 to $10 on average.
Lower than last year. Last year, the average was $80 on Brent. You expect the average for 25 to be 70 to 75?
Yeah.
And you also expect China to reach peak oil products demand this year?
Yeah, it's almost so, and also the gasoline would
Gasoline
be,
and diesel.
yeah, and diesel, but with jet fuel will have big expanding room in the future.
But this year, you expect China peak oil products, diesel and gasoline demand in 2025, and you expect Brent to be between 70 and 75 average.
Yeah.
Okay, sir. Thank you so much. It has been wonderful to have Dr. Wang Zhen kick off the 15th edition of the Global Energy Outlook Forum, making his forecasts, seeing peak oil products demand in China this year for diesel and gasoline, and an average on Brent from $70 to $75 a barrel. Thank you so much, sir. We will now move on to our second interview this morning. Someone very familiar with our program, of course, Mr. Jorge Montepeque, Managing Director, Benchmarks at Onyx Capital Group. Jorge, welcome. There you are. Let's bring up that handsome fella and ask Dr. Wang to close his camera and bring Jorge onto the screen. Thank you, Dr. Wang. All the best. We will circle back again. Jorge, welcome. I hope you heard some of what the gentleman from the Chinese National Oil Offshore Company said. The expectation for the year ahead, he saw peak oil products demand, gasoline and diesel in China, and a oil Brent of 70 to 75. Still holding on to the line of China 5% growth. Let's perhaps start there. You're in Singapore today. You've been all over Asia over the holiday season. I've been enjoying your cups of tea of the Vietnamese paddy fields and all the others. Very jealous, of course. But let's first start in China and then wander around the region with you. Your outlook for China on the year ahead.
Yeah, my outlook on China for the year ahead was very negative. And I have been in China for 3 times in the second half of the year. And I have sampled Beijing, the area near Shanghai, and deep in the hinterlands in Chongqing. But I do always reform my opinion if data starts to look a little bit different. So I initially was extremely negative. And of course, I didn't believe the official numbers on the rate of growth. In fact, initially, my perception was that there hadn't been growth for 2 or 3 years in places like Shanghai. And of course, in other areas it's different, but in that major metropolitan area, it's like time stood still. But China has made a great effort in setting the steps to inject liquidity into markets, reduce interest rates, and essentially kickstart even consumer demand by giving credits if you buy a new car and things like that. And my initial observations is that it is working. The number of sales of these durable goods, which I would call a car a durable good, is going up quite a bit. And that creates an impact down the chain because you need to buy some metals, you need to buy some copper, you need to buy wiring, you need to buy lights, you need to buy all of these things. So the Chinese economy, because of the central government intervention, is waking up.
Is it waking up sufficiently? We're seeing the early New Year data now with sort of big red flashing lights regarding deflation, the outlook, the 10-year bond outlook moving into negative territory. This is Japan 1990, no?
Yes. There is, like in anything, always 2 ways of looking at it. In the West, we have a crisis, in a way, with interest rates rising too fast. In China, we have the opposite. And the reason we have the opposite in China is because there's a lot of cash infusion by the central government, which then results in people buying the bonds and accepting lower yields, which in theory then transfers into the real economy. And some people are buying cars. And for a while, we're buying stocks. I think they already stopped buying on the stock market. But regardless, if you look at the high-level figures, car sales have gone up quite a bit. And there is already signs of some real estate markets waking up because they reduced the taxation and made it easier to buy a second home. So that means that the economy is finding a footing. Will that mean the official 5% roughly growth rate? I don't think so. And from my trips in the area, consumers and people are complaining that the markets are too slow. So one of the second steps the country is doing is trying to open China for tourism. And they're making it very easy for the outside world to come in. And I like to contrast very much what China is doing with what the West is doing, where it's very difficult to get a visa or you're not welcome in places like Barcelona and things like that. While in China now, it's very easy to do. Many countries don't need a visa. And for me, that I need a visa, I can go in up to 10 days.
Just
So
speak
this
to
is
the point
resulting
of
in more
the added layer of challenge this year. As we mentioned in the first interview with Dr. Wang, and that is, of course, the return of Donald Trump. And if he's been obviously barking about a lot of things and a lot of tariffs that will be part of his policy, but China is very much in his crosshairs to target China with more punitive tariffs than even Biden, who had already put a lot. What impact does that have, do you think, on China's growth target for this year and for its oil demand and consumption?
a definite slowdown. And China will need to redirect, and is redirecting towards the Southeast Asian market and also to Latin America and Africa. One of the things I'm very sensitive about in these trips is to observe car dealerships. And I just walk here in Singapore next to BYD. So China is just penetrating the car market very extensively. And
Same here
relative
in
to the
Dubai.
US,
Everywhere you look, there's BYD cars.
so relative to the US, China will underperform, I think, because of all this pressure. But relative to Europe, will massively overperform. And on a net basis, there'll be some growth, not as high as 5%, but some growth. But there is another casualty, and that is gasoline. Because China is pushing out those EV cars like there is no tomorrow. And the adoption rate inside of China is over 50%. The adoption rate in India is also growing. The adoption rate where you live in the Middle East is surprisingly high. And there are dealerships now in Latin America, in Africa, everywhere. So I think as we extend the observation line in gasoline, definitely I would be comfortable in saying peak gasoline consumption is behind us.
In
And right
China.
now, even globally.
Oof. Well, if
Even
it's China, I
globally.
suppose it is globally. Let's just take a step away from China, as you have done, as we said at the introduction, across Asia over the last number of weeks. What is the slowdown or is the challenge that China is facing at the moment good or bad news for the rest of Asia?
For the rest of Asia is cheaper products coming in because some of the exports, that machinery that produces all these consumer goods, some of it at the margin will need to be redirected from the US into Europe and into Southeast Asia. And this means deflation. Deflation is good. I like it when a product is cheaper than it was, right?
Yes.
When I have to buy a phone,
Especially
and it
after a lot
costs
of
less.
inflation.
Yeah, it's less than it was. And in Asia, people here are not so political. They look at the bottom line. They really don't care about the Green New World or global warming
But
of
deflation
all
tends
those
to make
things.
people save money. It makes people nervous. It doesn't make people very accommodating to the consumption habits of growth,
Frankly, I don't see it that way. Maybe
right?
that's more in a already mature economy, but in Vietnam, where it was just recently in the past few days, if things could cost less for them, they're happier, right? Why not? Then your dong, your dollar can go farther. You can buy more things. The quality of your lifestyle improves. So I think Southeast Asia in particular is going to be a beneficiary of the US-China trade war. And
Can
let's
the
not
rest of
forget,
Asia make up for the incremental demand loss of oil from China in 25? Over 30 years now, the engine of incremental demand growth has been China. It would appear that that period is over. Can the rest of Asia make that up, that loss?
no, I don't think so. India is doing its best. But India, relative to China in energy consumption, is about a quarter. So even if it grows at 5%, it cannot account for the loss in China. And of course, Indonesia is growing, Vietnam is growing, Thailand is still growing, and they have some economic troubles that I think come from the car industry, but the whole region is still growing, but it's not enough to compensate for China. This would suggest that peak demand, at least temporarily, we saw it in 24. And the 25 is
oil
going to be a
demand,
challenge.
peak products, or
Gasoline for sure, but I think we could even say in its totality, because gasoline is a big sector, and diesel is challenged because of the construction sector in China, and that transfers out into the region.
Let's
So
go to
I
the
don't-
survey question and then get your final predictions, Jorge, for what is the most critical factor shaping China's oil demand in 25? One, sustained economic growth and domestic consumption expansion. Two, impact of trade tensions and global geopolitical dynamics. Three, implementation of government fiscal and monetary policies. That's stimulus we talked about earlier. What is the most critical factor for shaping China's oil demand in 2025? Clearly, this is a question that you could put all of the above, but which of these is the most critical, do you think? Sustained economic growth, domestic consumption in China, the geopolitics, the trade war, bearish. Number one is clearly bullish. Number three is bullish too. One would think, can the stimulus work? The most critical factor for shaping oil demand in 2025. Jorge, your final 2 minutes, your forecast for 2025 for Asia-China demand for oil prices.
I think we are strong ahead of the Chinese New Year because people need to cover what they have. We have also seen that China in particular is buying ahead of a potential weakening of the yuan. So it's better for them to buy oil with a strong yuan now and store it, and the interest rate is so low that you can afford to do that, and that is leading to a surge early in the year. I think as we enter into the Chinese New Year, we will see a slowdown in consumption, and then we're heading into March, which is a period of turnarounds, and we are going to see a market decline in Q2. So strong Q1, weak Q2, and then hopefully Mr. Trump and China kind of sort out the differences and we see a better Q3, but maybe it's Q4. So this year will be full of volatility, up, down, maybe a bad down at the end of Q2, start of Q3, and then a recovery in Q4.
Let's see the survey result of that question we asked here. So 55% of the room thinks impact of trade tensions, the old tariff war, will be the biggest sort of impact on the direction of China oil prices, or not China oil prices, China oil demand. Jorge, you are amazing. I love your new job. I want it. Let's trade. I want to wander around the fields of Vietnam and other wonderful places. You're doing a great job. Really enjoy your posts on LinkedIn and your commentary with us on every occasion we can to get you. That is Jorge Montepeque, really wonderful Managing Director Benchmarks at Onyx Capital Group, doing great work. Thank you, Jorge. Have a great year.
Thank you so much.